Hello, beautiful people, and welcome back to Boni's Life, your weekly dose of crypto clarity in a world of digital chaos. This is the place where we cut through the noise, dissect the data, and give you the insights you need to navigate the thrilling and sometimes terrifying world of cryptocurrency trading. This week, we're diving deep into the aftermath of a rather surprising October, analyzing the technical tea leaves of Bitcoin's chart and preparing you for a week packed with market-moving events. We'll also be hearing from the big guns, the institutional players, the sharpest analysts, and even the folks at the Federal Reserve who, whether they like it or not, have a huge say in our crypto fortunes. So grab your coffee, settle in, and let's get ready to conquer the crypto market together. And hey, if you're new here, don't be shy. Hit that subscribe button and join our growing family of savvy crypto enthusiasts. You won't regret it. All right, let's get down to brass tacks. October, or as we in the crypto space lovingly call it Uptober, threw us a bit of a curveball this year. For the first time since 2018, Bitcoin actually ended the month in the red, breaking a 7-year winning streak. It was a bit like expecting a blockbuster movie and getting a low-budget film instead. Still good, but not quite what we were hoping for. The market has been a roller coaster, with Bitcoin starting last week around the $114,500 mark and ending it closer to $110,000. That's a dip of nearly 4%, which in the crypto world is basically a Tuesday. But it's the story behind the numbers that's truly fascinating. As you can see on the chart, we saw a clear rejection from the $116,500 resistance level early in the week. The bears came out to play, pushing the price down to a low of around $108,300, but the bulls, ever the optimists, stepped in and defended that support level beautifully. We're now in a bit of a consolidation phase, a tug of war between the bulls and the bears. It's like watching a high-stakes chess match, and every move matters. The daily chart is showing a neutral signal, which tells us the market is undecided. It's holding its breath, waiting for the next big catalyst. But if we zoom out to the monthly chart, the picture is much rosier, with a strong buy signal. This tells us that the long-term trend is still very much intact. So, while the short-term might be a bit choppy, the bigger picture is still pointing towards the moon, or at least a very nice view of it from the upper atmosphere. Now let's look at the broader market context. According to CoinGecko, the total crypto market cap stands at $3.82 trillion, up 0.9% in the last 24 hours. Bitcoin dominance is at 57.9%, which is relatively stable. This tells us that while Bitcoin is consolidating, it's still the king of the crypto castle. From a derivatives perspective, the data from CoinGlass shows some interesting dynamics. Open interest is at $157.6 billion, up slightly by 0.26%. This indicates that traders are maintaining their positions, waiting to see which way the market breaks. The 24-hour liquidation figure dropped significantly to $106.69 million, down 53.83% from the previous day. This suggests that the market is stabilizing after some volatility. The fear and greed index is sitting at 36, firmly in fear territory. But here's the interesting part. It's actually recovering from a low of 29 last week. Fear can be a trader's friend if you know how to use it. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. This recovery in sentiment, while still cautious, suggests that the worst of the panic may be behind us. Traders are starting to regain their composure, and that's often when the best opportunities present themselves. Now, if technical analysis is like reading the market's body language, fundamental analysis is like listening to its conversations. And this week, the market is buzzing with whispers and warnings. We have a packed calendar of events that could send shockwaves through the crypto space. First up, we have a series of major token unlocks for projects like Sui, Eigenlayer, and Ethena. For those of you new to the game, a token unlock is when a large number of previously frozen tokens are released into the market. This can sometimes lead to a drop in price as the supply suddenly increases. It's like a dam breaking, and we need to be prepared for the flood. On Saturday, we're seeing Sui unlock 43.96 million tokens and Eigenlayer unlock 36.82 million tokens. Sunday brings an Ethena unlock of 40.63 million tokens. These are significant numbers, and the combined value of all the unlocks this week exceeds $100 million. Smart traders will be watching these projects closely to see how the market absorbs this new supply. History has shown us that token unlocks can create short-term selling pressure, but they can also present buying opportunities if the fundamentals of the project remain strong. But the real headliner this week is the parade of speakers from the Federal Reserve. We have no less than 11 FOMC members scheduled to speak. That's more Fed officials than a Taylor Swift concert has backup dancers, and you can bet the market will be hanging on their every word. Any hint of a change in monetary policy, any whisper about interest rates could send Bitcoin on a wild ride. Remember, lower interest rates tend to be good for riskier assets like crypto, as it makes borrowing cheaper and encourages investment. So, we'll be listening very closely to what they have to say. It's like trying to decipher a secret code, but the prize is a whole lot bigger than a decoder ring. The most important speakers to watch are FOMC member Williams, who speaks twice this week, and FOMC members Daly, Cook, and Barr. These are influential voices in the Federal Reserve, and their comments on inflation, employment, and monetary policy will be scrutinized by every trader and analyst in the market. We're particularly interested in any hints about the pace of future rate cuts or whether the Fed might pause its easing cycle. The current market consensus is that the Fed will maintain its cautious approach, but any deviation from this expectation could trigger significant volatility. And as if that wasn't enough, we also have a slew of critical U.S. economic data coming out, including the latest numbers on manufacturing services and the all-important jobs report. These numbers give us a snapshot of the health of the U.S. economy, which has a huge impact on global markets, including crypto. A strong economy could give the Fed more room to keep interest rates high, which could be a headwind for Bitcoin. A weaker economy, on the other hand, could force the Fed to ease up, which would be music to the ears of crypto investors. It's a delicate dance, and we're all watching to see who takes the lead. On Monday, we get the ISM manufacturing PMI, which is expected to come in at 49.2, just slightly above the previous reading of 49.1. A reading below 50 indicates contraction in the manufacturing sector, so we're still in slightly negative territory. Wednesday brings the ADP Employment Change Report, which is expected to show a gain of 25,000 jobs after a surprising loss of 32,000 jobs in the previous month. This will be an important indicator ahead of Friday's non-farm payrolls report. The ISM Services PMI on Wednesday is expected to improve to 51.0 from 50.0, suggesting modest growth in the services sector. Friday's non-farm payrolls report is the big one. This is the most closely watched employment indicator in the world, and it has the power to move markets dramatically. We don't have the exact expectations yet, but any significant deviation from consensus could trigger a major reaction in both traditional and crypto markets. We'll also be watching the Michigan Consumer Sentiment Index, which is expected to tick up slightly to 54.0 from 53.6. Consumer sentiment is important because it gives us insight into how Americans are feeling about the economy, which influences spending and investment decisions. We also have some exciting protocol upgrades happening this week. On Monday, Sonic is launching its mainnet upgrade, which is a significant milestone for that project. Monad is also opening its airdrop claim on Monday, which could generate a lot of excitement in the community. Tuesday brings the Polkadot Hub launch, a major development for the Polkadot ecosystem, and the IOTEX Core Fee 2.3.0 hard fork. Wednesday sees the Linear Exponent launch. These are all significant developments that could drive price action in their respective ecosystems. For traders who follow these specific projects, these events could present interesting opportunities. It's one thing for us to read the charts, but what are the big players, the whales of the financial ocean, saying? Well, the whispers are getting louder. We're seeing a fascinating divergence in opinion. On one hand, you have seasoned analysts like Luck Davis, who has called November Bitcoin's strongest month, pointing to a historical average gain of a whopping 42.5%. That sounds like rocket fuel, right? But hold your horses. A closer look at the data, courtesy of CoinGlass, shows that the median gain is a more modest 8.8%. It turns out that a single outlier year, way back in 2013, is skewing the average. It's a classic case of statistics telling two different stories. It's a good reminder that while history is a great teacher, it's not a fortune teller. This is an important lesson in statistical analysis. When we look at averages, we need to be aware of outliers that can distort the picture. The median, which represents the middle value when all the data points are arranged in order, often gives us a more realistic expectation. So while November has historically been a strong month for Bitcoin, expecting a 42.5% gain might be overly optimistic. A more realistic expectation based on the median would be somewhere in the high single digits to low double digits. Still a solid return, but not quite the moonshot that the average suggests. On the more bullish side of the spectrum, we're seeing some incredibly ambitious price targets. Some analysts are eyeing a potential surge to $250,000 by the end of the year. Now, that would require a 127% rally from where we are now. To put that in perspective, the biggest monthly gain in Bitcoin's history was about 89%. So, while it's technically possible, it's a very high-risk scenario. Charting analyst Cass Abbey has pointed out a classic bullish pennant forming on Bitcoin's daily chart, a pattern that often precedes a significant upward move. He says, and I quote, "Next week is going to be very crucial. Bulls are expecting a breakout to the upside, while bears are expecting more pain. The battle lines are drawn. The bullish pennant is a continuation pattern that forms after a strong upward move. It's characterized by converging trend lines that create a triangular shape, with the price consolidating within this range before breaking out. If Bitcoin breaks above the upper trend line of this pennant, it could signal the start of another strong upward leg. The key is to watch for a breakout on high volume, which would confirm that buyers are stepping in with conviction. Without volume confirmation, we risk a false breakout that could trap bullish traders. There's also an interesting macro catalyst that's fueling some of this bullish sentiment. The Federal Reserve recently injected $29 billion in liquidity through overnight repo operations. Some analysts are drawing parallels to similar actions in 2020, which preceded Bitcoin's run to its then all-time high. While the exact impact of this liquidity injection is still being debated, history suggests that when the Fed adds liquidity to the system, it tends to support risk assets, including Bitcoin. It's not a guarantee, but it's certainly a factor worth considering. And it's not just the technicals that are fueling this optimism. The institutional adoption story is getting stronger every day. We're talking about giants like MasterCard, who are reportedly in talks to acquire a stablecoin infrastructure platform called ZeroHash for nearly $2 billion. This is huge. MasterCard is one of the largest payment processors in the world, and their move into crypto infrastructure signals a major shift in how traditional finance views digital assets. The stablecoin market has an adjusted annual volume of approximately $9 trillion, and MasterCard clearly wants a piece of that pie. Visa is expanding its stablecoin payment services, having already facilitated over $140 billion in stablecoin flows since 2020. Visa CEO Ryan McInerney has reiterated the firm's commitment to integrating blockchain technology and stablecoins into their payment infrastructure. They are now supporting 4 stablecoins on 4 different blockchains, with the ability to convert to 25 fiat currencies. This is the kind of real-world utility that crypto has been promising for years, and it's finally coming to fruition. The fact that it's being driven by household names like Visa and MasterCard gives it a level of legitimacy that's hard to overstate. And then there's BlackRock, the world's largest asset manager. Their CEO, Larry Fink, has predicted that the market for real-world asset tokenization could reach $10 trillion. To put that in perspective, that's larger than the entire current crypto market cap. BlackRock's spot Bitcoin ETF has already attracted over $100 billion in assets, making it one of the most successful ETF launches in history. Now, their backed tokenization firm, Securitize, is going public via a SPAC deal valued at $1.25 billion. The merger is with an affiliate of Cantor Fitzgerald, which has been a long-time service provider to Tether and the USDT stablecoin. These aren't just whispers anymore. These are roars from the biggest players on Wall Street. They're not just dipping their toes in the crypto pool, they're building the entire water park. This is the kind of institutional validation that could drive the next major bull run. When you have companies like BlackRock, Visa, and MasterCard making billion-dollar commitments to crypto infrastructure, it sends a powerful signal to the rest of the financial world. It says that crypto is here to stay, and it's becoming an integral part of the global financial system. Professor Sean Stein-Smith, writing for Forbes, highlighted 3 key signs of institutional adoption that investors should watch. First, the payment processing giants are prioritizing stablecoins and on-chain payments. Second, stablecoins have taken center stage as the everyday crypto use case, delivering quantifiable benefits to all participants in the transaction. And third, Wall Street is moving aggressively into real-world asset tokenization. These aren't speculative plays. These are strategic moves by some of the most sophisticated financial institutions in the world. They've done their homework, and they see the future of finance being built on blockchain technology. So, with all this information swirling around, how do we actually trade this market? How do we dance in this crypto rain without getting soaked? Well, let's break down some potential strategies for the week ahead. Remember, this is not financial advice, but rather a framework to help you think through your own trades. Always do your own research and never risk more than you can afford to lose. First, let's talk about our key levels. We have a strong support zone between $108,000 and $110,000. This is the area where the bulls have shown up in force, and it's a critical line of defense. Below that, our next major support is down at $105,000. On the upside, our immediate resistance is at $115,000, and a bigger hurdle lies at $120,000. These are the battlegrounds where the bulls and bears will be fighting for control. Now, for our bullish scenario, if we see a decisive breakout above that $115,000 resistance, especially on high volume, that could be our signal that the bulls are back in charge. This would confirm the bullish pennant formation we talked about earlier. A potential entry point could be on a retest of the breakout level, with a target of $120,000 and then potentially $134,000. A stop loss could be placed just below the breakout level, around $114,000, to protect against a false breakout. This gives us a risk-to-reward ratio of about 1 to 3 on the first target and 1 to 12 on the second target, which is quite attractive. The key to this strategy is patience. Don't chase the breakout. Wait for the price to break above $115,000, and then wait for it to come back and retest that level as support. This retest is important because it confirms that the breakout is legitimate and that buyers are willing to step in at higher levels. If the retest holds and the price bounces, that's your entry signal. Set your stop loss just below the retest low and let the trade work. If it hits your first target at $120,000, consider taking some profit and moving your stop loss to break even on the remaining position. On the flip side, what if the bears win the day? If we see a breakdown below the $108,000 support level, that could signal further downside. This would invalidate the bullish pennant and could open the door to a test of the $105,000 support level. A short-term bearish strategy could involve entering a short position on a break of $108,000 with a target of $105,500. A stop loss could be placed just above the breakdown level, around $108,500. This gives us a risk-to-reward ratio of about 1 to 2, which is acceptable for a shorter-term trade. Again, the key is confirmation. Don't short just because the price is approaching support. Wait for a clear break below $108,000, preferably on increased volume. Then wait for a failed retest of that level, where the price tries to get back above $108,000 but fails. That failed retest is your entry signal for a short position. Keep your position size smaller on bearish trades, as the long-term trend is still bullish and you're essentially trading against the trend. The key this week is to be patient and wait for confirmation. Don't jump the gun. Let the market show you its hand, and with all the news events happening, be prepared for volatility. It could be a wild ride, but with a solid plan, you can navigate it with confidence. It's like surfing. You can't control the waves, but you can learn to ride them. For those of you looking at altcoins, keep an eye on Ethereum, Solana, and XRP. Ethereum is currently trading at $3,908, up 1.2% in the last 24 hours. The technical indicators for Ethereum are similar to Bitcoin, showing short-term strength but daily neutrality. Ethereum has strong support around $3,800 and resistance at $4,000. A break above $4,000 could open the door to a test of $4,200 and potentially higher levels. Solana is at $187.61, showing strength with a 0.92% gain. Solana has been one of the stronger performers in the altcoin space, and it's showing relative strength compared to Bitcoin. This is a good sign for Solana holders. The key level to watch is $200, which has been a psychological resistance level. A break above $200 could trigger a strong rally toward $220 and beyond. XRP is at $2.53, up 1.09%. XRP has been consolidating in a range for several weeks, and it's showing signs of building energy for a potential breakout. The key resistance is at $2.70, and a break above that level could trigger a move toward $3. However, XRP can be quite volatile, so make sure to use appropriate position sizing and risk management. The altcoin season index is at 43, which is neutral, suggesting we're not quite in full altcoin season yet, but we're getting closer. Historically, altcoin season tends to follow Bitcoin rallies as profits from Bitcoin flow into altcoins. If Bitcoin can break above $120,000 and establish a new uptrend, we could see altcoins start to outperform. Keep an eye on this index as a gauge of market rotation. One more thing I want to mention is the importance of risk management. In a volatile market like this, it's crucial to protect your capital. Never risk more than 2 to 3% of your portfolio on a single trade. Always use stop-loss orders to limit your downside. And don't let emotions drive your decisions. Fear and greed are the two biggest enemies of successful trading. Stick to your plan, follow your rules, and don't deviate just because the market is moving against you. And it's also important to be aware of the scheduled news events this week. When we have major economic data releases or Fed speakers, the market can move violently in either direction. Some traders prefer to close their positions ahead of these events to avoid the risk, while others see them as opportunities to profit from the volatility. There's no right or wrong approach. It depends on your risk tolerance and trading style. Just make sure you're aware of when these events are happening so you're not caught off guard. And that's a wrap for this week's crypto market analysis. We've covered a lot of ground, from the technicals to the fundamentals, and heard from some of the brightest minds in the space. The key takeaway for this week is to be vigilant. We have a market that's technically coiled for a big move, a calendar packed with potential catalysts, and institutional players making serious moves in the background. It's a recipe for an exciting and potentially profitable week. Thank you so much for joining me on Boni's Life. I hope you found this episode insightful. If you did, please give this video a thumbs up and don't forget to subscribe and hit that notification bell so you never miss an episode. I love hearing from you, so please leave your comments and questions below. What are your predictions for the week ahead? Let's continue the conversation. Until next time, trade smart, stay curious, and live your best crypto life. Bye for now, or